Another day, another multi-million-dollar crypto collapse. But this one is different, and if you hold any stablecoins, you need to hear this story. $25 million vanished overnight from Resolv protocol. Their so-called stablecoin USR crashed 70%, and right now they're sitting on $95 million in assets against $173 million in liabilities. That's not just bad math, that's functional insolvency. Welcome back to the channel where we break down the crypto stories that actually matter for your portfolio. I am your host, and today we're diving deep into the Resolv Stablecoin disaster that's sending shockwaves through DeFi. By the end of this video, you'll understand exactly what happened, why it matters, and most importantly, how to protect yourself from the next protocol collapse. Let us start with the basics. Resolv was marketed as a revolutionary stablecoin protocol, promising users they could mint USR tokens backed by a basket of assets. The key word there was. Because as of this week, USR is trading at 27 cents, that's a 72% drop in just 7 days. Here's what we know happened. An attacker identified a critical vulnerability in Resolv's smart contract architecture. Think of it like finding a backdoor in a bank vault. Once they had access, they systematically drained $25 million worth of ETH from the protocol's reserves. But here's the scary part: this one some sophisticated hack that required months of planning. This was a fundamental flaw in how the protocol was designed. The technical details matter here, so stay with me. Resolv used what's called a rebase mechanism to maintain the peg. Essentially, the protocol would automatically adjust the supply of USR tokens based on demand. When demand was high, it would mint more tokens. When demand was low, it would burn tokens to reduce supply. Sounds reasonable, right? Except the smart contract had a critical flaw in how it calculated these adjustments. The attacker exploited this calculation error to trigger massive token mints while simultaneously draining the underlying collateral. It's like counterfeiting money while robbing the mint at the same time. By the time the protocol's automated systems caught up, $25 million in ETH was already gone. If you're finding this valuable, smash that like button, it helps more people see this. Because what happened next reveals something even more disturbing about the state of DeFi. Let us talk numbers, because the math here is absolutely brutal. As of right now, Resolv Protocol holds $95 million in various assets, primarily ETH, some wrapped Bitcoin, and other DeFi tokens. Against that, they have outstanding liabilities of $173 million. That's a $78 million shortfall. To put this in perspective, imagine you owe $173,000 but only have $95,000 in the bank. You're not just broke, you're bankrupt. And that's exactly where Resolv finds itself today. But here's what makes this even worse. The protocol's governance token, which we call Resolv, has also crashed over 60% this week. Why does this matter? Because many DeFi protocols rely on their governance tokens as a backstop for exactly these kinds of situations. When your backstop is also collapsing, you're in serious trouble. The ripple effects are already spreading. 3 major DeFi protocols have announced they're removing USR from their accepted collateral lists. Curve Finance, one of the largest decentralized exchanges, has paused USR trading pairs. And here's the kicker: at least 2 other stablecoin protocols are now under scrutiny for using similar rebase mechanisms. Fun fact: 80% of you watching aren't subscribed yet. If you want to stay ahead of the market and avoid disasters like this, fix that now. So what does this mean for the broader crypto market? First, it's another reminder that the stablecoin space is still the Wild West. We've seen Terra Luna collapse, we've seen various algorithmic stablecoins fail, and now we're rewatching Resolv join that graveyard. But there's a bigger picture here. When major DeFi protocols collapse, it creates what economists call contagion risk. Other protocols that were integrated with Resolv are now scrambling to assess their own exposure. Liquidity pools that included USR are being unwound. And investors are starting to question other experimental stablecoin designs. The timing couldn't be worse either. We're already in a challenging macro environment with traditional markets showing volatility. The last thing crypto needed was another high-profile protocol failure. But that's exactly what we got. Interestingly, this collapse is also highlighting the concentration risk in DeFi. Resolv wasn't some tiny protocol operating in isolation. It had integrations with major DEXs, lending platforms, and yield farming protocols. When it failed, it created problems for dozens of other platforms. Now, what does this mean for you as an investor or DeFi user? First and most importantly, this is a stark reminder that not all stablecoins are created equal. There is a huge difference between USDC, which is backed by actual dollar reserves held by regulated institutions, and experimental protocols like Resolv. If you're currently holding USR, the unfortunate reality is that your options are limited. The protocol has announced they're reworking on a recovery plan, but with a $78 million shortfall, even the most optimistic scenarios involve significant losses for token holders. For those using other stablecoins, this is your wake-up call to do a security audit of your holdings. Ask yourself these questions: what type of stablecoin are you holding? How is it backed? What is the track record of the issuing organization? And most importantly, are you diversified across different types of stablecoins? Here is my practical advice moving forward. First, if you're going to hold stablecoins, stick to the battle-tested ones. USDC, USDT, and DAI have proven themselves through multiple market cycles. Yes, they might not offer the exciting yields that experimental protocols promise, but they also don't randomly lose 70% of their value overnight. Second, never put all your stablecoin holdings into a single protocol, no matter how promising it looks. Diversification isn't just for your crypto portfolio, it is essential for your stablecoin strategy too. Third, if you yield farming or providing liquidity, understand that higher returns usually come with higher risks. Resolv was offering above market rates on USR deposits right up until the collapse. Those attractive yields weren't free money, they were compensation for taking on additional risk. Fourth, learn to read the warning signs. Protocols with anonymous teams, unaudited smart contracts, or complex mechanisms that can be easily explained should set off alarm bells. If you can understand how a protocol maintains its peg, you probably shouldn't be using it. Finally, and this is crucial, always have an exit strategy. The DeFi space moves incredibly fast. By the time you realize there is a problem, it might already be too late to get out without significant losses. Looking ahead, I expect we'll see increased regulatory scrutiny of stablecoins, especially the more experimental varieties. The Resolv collapse is going to be Exhibit A in any regulatory hearing about the risks of unregulated digital assets. While I am generally not a fan of excessive regulation, some oversight in the stablecoin space might actually be beneficial for long-term adoption. We're also likely to see more consolidation in the stablecoin market. Investors and protocols are going to become more conservative, favoring established players over innovative but risky newcomers. This might slow innovation in the short term, but it should lead to a more stable foundation for DeFi growth. The Resolv disaster is ultimately a reminder that DeFi is still in its early stages. We're dealing with experimental technology, untested economic models, and significant smart contract risks. That doesn't mean you should avoid DeFi entirely, but it does mean you need to approach it with appropriate caution and risk management. Drop your prediction in the comments. Do you think we'll see more stablecoin collapses this year? I read every single one. And subscribe if you want to be early on the next market move, because in crypto, information is your best defense against disasters like this. Before you go, make sure to check out my video on the 3 warning signs that predicted the Terra Luna collapse. The patterns are remarkably similar to what we saw with Resolv. The link is right here on your screen. Remember, in crypto, the best defense is education and preparation. Stay safe out there, and I'll see you in the next one.